So thanks for joining us this week. We have a training this week on the infinite banking concept, something I know very little about. However, I do have a lot of questions. We have a lot of people that have asked about it, wanted to look into it because it sounds like there's a lot of great opportunities to have when be able to utilize like this. So let me just be very clear about this to everybody that's on here watching. Simplified issue is still our bread and butter here at Family First Life. It still is the way that's going to get most people covered, get agents paid the quickest, and it's just easier for in a lot of respects. Especially with the leads that we work. The difference is, in certain situations, there's certain people looking for very specific things, people in a certain financial position, or people that have certain needs that need to be taken care of that can't be covered by those products. This is when it's great that we have resources such as Scott Genad, who's going to be coming on and sharing with us about the infinite banking concept. This actually all originated because it started with a question. I had a friend that asked me, he was looking to get into insurance. He sent me, and he owns a business. He sent me a reel on Instagram, and on that little video, that little short video, it's something about tax advantages if you can get a IUL policy. That's what rich people do. They get an IUL policy. Their business pays for it, then they're able to get tax advantages. And then I was like, sounds really cool. I don't know if it's legal. I don't know if it's plausible. And I actually reached out to Sean Ruggiero, who heads our AMS department. And then he texted back. He said, "Hey, I got a guy that handles our infinite banking concept, department now, and Scott Genad." So he put me in touch with him, and Scott and I talked briefly, and he said, and he was so gracious to come on and share this great information with us and train about this, because while a lot of people have asked me questions, I'm like, I don't know that much about it. So why not defer to an expert? This is why we have these resources. So anytime you have these resources, you got to take advantage of it. So Scott, if you could. You could take over and enlighten all of us on how this infinite banking concept works. First of all, appreciate you coming on.
Yeah, no, I appreciate you. Appreciate your time and your team's time. Try to keep it within, 35, 40 minutes to an hour. It just depends. You let me know, because I can talk for hours. Sean knows. So limit me if we need to, but if it makes sense and everyone else wants to stay on, just let me know. But I've been in the industry of retirement services for over 15 years. I worked in my earlier career for teachers. I'm in Florida, so for the Broward County schools. So I worked through principals, vice principals, and so on, educating them on accumulation of their money. Then over the last decade, I worked for a post-retirement firm where it was just very wealthy multi-millionaires, where we did estate planning, skip design methods. We were doing different types of annuities to pay for life insurance, for estate planning tools, some different tax mitigation strategies. So I have a lot of knowledge more of on the annuity and fully underwritten life insurance, and predominantly IUL was my sector with my firm. So I've been a big IUL advocate. I know how they work now more than I did ever, because you only know what you know and how you're trained and taught by your mentors or the people that are training you. Today it's more about understanding how this concept works with the term infinite banking. And I'd like to say that the majority of the misnomers out there are, you can't do a lot of the functions that infinite banking is being talked about using Index Universal Life. You can, but the majority of them don't. And it's all depending upon how you structure them. So today is not, like I mentioned to Albert, today is not a knock on an IUL or a bashing, because I have an IUL. I have two of them, one for myself and one for my son. And even, Sean knows that I'm like the whole life guy now. That's kind of what infinite banking is utilizing it. And if you understand the term banking, right, it's capital, it's liquidity, it's having access to your money like right now, right? That's what banking, it's a banking function. I can go to Bank of America right now and walk in the bank and ask for money, and I'll get whatever it is in my bank account. And that's what you get. When it comes to the Index Universal Life program, you are utilizing that more of a investment concept. It's a long-term tax-free investment concept. So, and we know when we look at these illustrations that usually in the first couple of years, we see what, 0 or at least maybe 10% of whatever we put in. And that's because us, the agents, we have to feed our family too. We have to make money. And we are taking, 99% of the target is our commission. And we are explaining to the client that, look, this is a long-term investment, right? It's for tax-free. It's not for instant access now. Now, there are some situations out there where you can illustrate a policy where you are giving up your commission so that the client can access more cash, which could be somewhere around 30 or 40% of the actual target premium in their cash value. I rarely see an illustration for an index UL illustrated that way, where they're giving, someone puts in $6,000 a year of premium and the net cash value at the end of 1 year is like $4,000 or $3,000. I don't see that with a lot of IUL illustrations. If that's the case, let me know, bring it to me and let me see it. But the majority of us that are selling the IULs for tax-free retirement, you can't use it as a banking function because you're not getting a lot of access to your cash. So does that make sense? So I'm just giving you an idea, because I know there are videos floating out there where, yes, you can put money into an investment vehicle, or maybe not an investment vehicle, but a banking function where you can borrow money from it and use it where your business gets it. You can loan it back out to yourself at a higher interest rate, get the tax deductions, this and that. I think it's kind of a little risky, in my opinion, also, because then if you do get audited from the IRS, they want to know, where's the money coming from? Is it coming from a life insurance policy? Well, that's not. Where is it coming from? An investment? And life insurance is not deemed an investment. It's deemed life insurance for protection, right? It's not an investment. And that's why they have rules and regulations. So I think that's a thin line between how you can do that. But I have heard that you are able to borrow money from a life insurance policy and have the loans going to the business, right? And then the business can then, you charge yourself 10%, I don't know, and write it off for the interest. I think you have to have a good accountant, number one, and you have to itemize it, number two, and number three, if you ever did get audited, they're going to find out where did the money come from and how did you pay yourself back, and you might have sticky fingers after that. I don't know.
I mean, well, I mean, as far as that specific question, I mean, whether or not that's possible to, get one on your business and then borrow from it and write it off and all this other stuff, it sounds plausible from what you're saying. Sounds plausible from the little bit of really shallow research that I did. However, yeah, as Sean would always advise, reach out to a tax advisor specifically about your situation.
Yeah, we're not tax people. We can't tell people what to do. But two things you can do. One is you're getting a policy on yourself, a personal policy. And two, the company we're utilizing right now is Lafayette Life Insurance Company. That is our mutual insurance company we're going to utilize for whole life. And the reason why we're using Lafayette Life Insurance is not because we just picked them out of the hat. It's because Sean vetted them to see which one was going to be the best mutual insurance company. And I'll go into the differences of what a mutual company is and a stock company is, so you guys understand the difference. But the reason being is because we have people like Foresters. They're a mutual company. We have people like Mutual of Omaha. They're a mutual company. But they have to be designed specifically for those models of infinite banking. And Foresters can do it, but they can only write member to members, which is only individual to individual. They don't have a retirement services division that can also give business owners the opportunity of getting a policy for tax-free, not for tax-free, for a lifetime income stream. So Lafayette gives us both on their chassis. We can do one personal for infinite banking for whole life. And then we can also do a program for business owners where, yes, if you saw the other webinar that Sean had, Mark Ditondo and Don Kuhn for Lafayette, they did a presentation from Lafayette where you can ask business owners, hey, look, would you like to write off up to $400,000 plus of tax deductions and at the same time put together a lifetime pension, altogether using life insurance and annuities? And that might be a way to deduct from your business, right, and have a lifetime pension at the same time, which maybe it's very different than what some people on social media are displaying as personal, right? Because we're 1099s as family first.
I have an ignorant question for you. You said, what did you say? What type of company was Lafayette?
Lafayette Life is a mutual insurance company.
Mutual.
So yes,
what's the difference, and what's a mutual company?
I'm going to do this right now since we're here, and I'll come right back into some of the other stuff. So you can see here, I'll just blow this up here. You can see my screen?
Oh, got it. Stock company versus mutual company. Yeah.
Yeah.
We can see
So
it.
we got the stock company versus mutual insurance company. What that means is when you work with a stock insurance company, they answer to who? To the shareholders for
Got it.
profits, right? So they make money for the stockholders. So that's their job. And when you have a mutual insurance company like a Mutual of Omaha or Lafayette Life Insurance Company, when you pay premiums to that company, you become a policy owner of the company. So you participate in the profits of the company. So we participate in the profits of a dividend. That's what we participate in. And the dividend is just where we put premiums into the company. The company takes all the money and they see at the end of the year, all right, well, how much did we spend for mortality and expenses, the admin fees? How much do we pay for advertising, which Lafayette has like alligator arms, right? They don't really spend very much. That's why you may not have heard about them, but they've been around over 117 years. But at the end of the day, when there's a profit, they give you it back in the form of a dividend, which the IRS deems like a return of your own money, which is good for us because that's just tax-free money. I don't care what they deem it. As long, call it whatever you want. As long as I know it's a dividend, it's guaranteed no matter what. Once that money goes into your account, it's 100% locked in. It's yours and it's tax-free. And you can see here that dividends for a stock company, they're usually a majority of them are taxable. And the risk is just they're incentivized to take on a risk. So a stock company takes on the risk to make profits for the shareholders. Mutual companies don't. They're very reserved, right? They hold back as much. They don't spend a lot. They want to give back to the company, so they're profitable. And that's why mutual companies that have been around over 100+ years have never once missed a dividend through the Great Depression of 29, through World War, through the tech bubble, 01, 08. Doesn't matter. They've always received a dividend. Anyone, even through the 08 crash recently, has received a dividend. Whether it's 4%, 6%, 8%, 5%, whatever it is, it doesn't matter. They didn't lose any money. So when you have a whole life program, which I'll get into a little bit later, it will explain to you that it has nothing to do with any market speculation. The premiums are level, just like when we sell final expense, level death benefit, level premium. It doesn't go up, doesn't go down. That is what you're paying for from age 40 to age 90. Doesn't make a difference. That is your number. Universal life, it's the increasing cost of insurance. As we get older, we pay more. That's what UL, whether it's variable, whether it's just regular UL, or whether it's index UL, they're all the same. It's increasing cost of insurance. So the cost today at 40 is going to be very low versus how old you're going to be at 80. When you start taking money out for tax-free retirement, the cost is going to be higher. And just so you know, this is just articles back in Forbes 2008, rumors that publicly traded insurers are scrambling for cash by cutting dividends and issuing new shares. So they were just diluting everything. So that's why back then they were losing money. Mutual companies were staying strong and they always pay the dividend. They held steady. So just understanding who controls what, right? The stock companies in any index or UL, they control everything. They can raise the cap rates, lower the cap rates. They can raise your loan rates if they want to. They control everything, right? They have all the tools in their tool belt. A mutual insurance company, they don't. You become a part owner of the company, so you participate in it. I'll go back here so everyone understands. Can you see the top, or is my screen covering this?
We can see you.
Okay. So what is infinite banking? Everyone can read this if they like. I'll just go into a general idea. It's not a product. Okay. It's a process by we utilize dividend paying whole life insurance policies issued from mutual insurance companies, which you just saw. I explained what a mutual insurance company is. So what we're trying to accomplish here is we're trying to accomplish a vehicle using a banking function where we want to have access to it immediately, like liquid. Like if I put in $10,000 and I can get access to 80% of it, 90% of it right now, that is a policy I want, right? I want to get access. I don't want to wait. So the question you got to ask yourself is, what are banks doing? How do banks make money? That's the question. Well, do you think a bank opens up a new branch in the corner and just has like money sitting in there to give? No, they're waiting for us to walk through the door to give them deposits. And when our deposits are in there, now they can loan our money out and make a spread. So what does the bank give us? They give us what? Maybe 0.002%. If you're lucky, maybe you have enough money to earn 1%. If you're with a credit union, maybe. But let's be very, very generous here. So you can see here, the bank has $100,000 of our money, and they're going to give us 4% back. Very generous, very nice of this bank. I wish I had this bank right now. The market would be tumbling right now. It'd be a zero. Anyway, so we got 4% that they're going to give us. But when we have money in the bank, what do? Well, maybe somebody wants to buy a house. Well, they give us our money and they loan it out for 7% back there and comes right back into the bank. Well, maybe somebody wants to purchase a car. Oh, well, they'll loan our money out and charge them 8%. So they make the spread. Now, let's somebody wants to remodel their house. Well, they'll charge them 9% and money flows right back to the bank. Maybe somebody wants a credit card for at 12%. So if we add all these spreads up, this is how much money the banks are making just on this spread alone. Okay, 500% return on our money, and that's giving us 4%. So on average, they're really getting anywhere between 500 to 1,300% return on our money, and they're only giving us 0.00 something percent. So if the banks know and understand how to leverage money, then why the heck don't we understand how to do this? And why don't we do it for ourselves? And that's really where infinite banking comes into play. And if you go back and understand where banks actually put their money, I'll just let you know here. I don't know if you guys can read this. Let me show it to you. This is how much money. I don't know if you can read this, Albert, but that's how much. Can you guys see that? Yeah, that's how much money banks have right now in whole life cash value, $51 billion. We're talking Bank of America, Wells Fargo, JP Morgan, US Bank, $51 billion of their money is inside of whole life cash value, not universal, not variable universal, not index, because they understand how to do risk management. They don't look for things that are speculative. They look for things that are guaranteed, basically. And from companies that have been around over 100 plus years, that's where they put their money, right? So they understand how banks work. And there's something out there which everyone can research. It's called a BOLI. If you ever heard of that, it's called a bank-owned life insurance policies, where they take policies over on their executives. So if you walk into the bank next time, maybe see a guy that wears like a gold pin and he just got made executive. Congratulations, go hand out these lollipops, these suckers. And there you go. But what we're going to do is we're going to go ahead and give you a promotion, and we're going to get you life insurance, where if you die, a portion of that will go towards your beneficiary, right? But while you live, guess what's going to happen? We're going to stuff as much cash as we can in that cash value account, where we, the bank, have access to utilize it whenever we want, tax-free. And when you die, right, we're going to receive the proceeds tax-free as well. How's that sound? So that's how the banks make a lot of money. That's why banks have tier 1 capital. Their money is liquid gold. So anyway, yeah, we are recording this, I believe. Right, Albert? Somebody asked? Okay. So I'm just giving you guys an idea. If banks are doing this, banks are not taking risks. Banks are loaning their money. Banks have liquidity. Why aren't we taking advantage of the functions? So in the video that Sean and I did back a month or so ago, it explained to you how these individuals, like a Walt Disney, right? Walt Disney was trying to get his amusement parks up and running. Banks weren't loaning any money. He said, well, where am I going to get the money? So he had tons of money sitting in his cash value whole life policies, where he was able to access that as a tax-free loan to create his amusement parks. And that's where we have Walt Disney, Disneyland, all this stuff today, which is thankfully. You got to ask yourself, what did Ray Kroc do for McDonald's to pay his employees in a recession period? Well, he had whole life cash value where he was able to borrow to pay his employees. And that's how we have McDonald's today all around the world. We can go on and on. JCPenney did the same things for his department stores. Guys, these people didn't use anything speculative. IULs, ULs, VULs, all this stuff has only been around since the 80s and 90s or 2000s, really. Whole life has been around for over 200, 300, whatever, centuries, right? Centuries, not decades, centuries. It has been there since the test of time, right? So if that's the case, why don't we just follow along with what the banks are doing instead of trying to reach for the stars for 15%, 140% participation of 10, you know what I mean? Like, we keep reaching for the highest peak as we can. Why don't we just go with something with an exponential curve, right? It's like asking the question, would you rather have $1 million today or a penny that doubles every day for 30 days? Right? Do you know which one that one? Have you heard that one before, Albert?
I have.
Yeah. So at the end of the day, that's 5 point something million dollars versus the million. And that's what happens in the last couple days in the 30 days. It just takes off like a rocket ship. And that's what exponential curve can do when you're reaching for compounding interest, which I thought I did have that slide on here. Let me see if I did. No, I didn't put it in. I have it though. But this is how we spend money. It's called compounding interest. Albert Einstein's eighth wonder of the world. That's where we get it from. And if anyone understands it, then they'll earn it. Those that do earn it, and those that don't. This is what we do when I spend our money. We get paid. Majority of it goes towards automobiles. We spend it on housing, everything else. And this is how much money people save. The average American, that's what we do. We save just this much, maybe 5 or 10%. We have to try to get that number higher so we can get out of this rat race of debt. Whether we own a car or a home or personal loans or student loans, credit cards, we have to find a way to get out of this thing called debt. Let me see here. Hold on a second. So any questions so far, Albert?
No, I mean, we're taking in a lot right now, so it's been great.
All right, so I'm going to just go over and touch on a little bit. Well, if anyone, before I forget, everyone should, I'm not telling anybody what to do. That's not my job, but I will recommend, highly recommend everyone get this book. It's, you get it online, it's free. You can download it. It's called Becoming Your Own Banker by Nelson Nash. This is the creator back in the 80s. And you'll understand that what Nelson Nash has done is just found a way that all the multi billionaires, wealthy people, banks, and everyone have been doing. They found a way to utilize life insurance the proper way as a banking function. So just so everybody understands, whole life, the way we structurally engineer and design it, is very different than your broke brother-in-law that just got his license and wants to sell you a whole life. There are things out there that you might see Dave Ramsey or Susie Orman talk about. Whole life is the worst investment, highest death benefit possible. Why would you want to borrow from yourself and then pay someone else back interest? Rah, rah, rah. Just save your money. Scarcity. Let's just save our money. You know, pinch the pennies a little bit, pay off the highest debts or credit cards, and then just maybe you'll have a little bit more money to save at the end of the day. Well, I'm here to tell you that could be further from the truth. Because yes, whole life is a bad investment if it's structured improperly from someone who doesn't know what they're doing, right? It isn't this buy term invest the rest thing back in the day, which, you know, I don't know how he got that with Art Williams, and, you know, I won't name people, but this book right here will explain to you exactly how whole life works. And even though back in the day, the integral parts of the program may be a little different than they are today, it helps in our favor. It's just a way of getting around the regulations that they put on us today. Because back in the day, you can just throw $100,000 into the policy, a whole life policy, and get 100,000 back out. Can't do that. It's like tax sheltering. Right. So they have to have a little rules today so that it passes the MEC test, the modified endowment test, and they call it a 7-pay test. This another book, if somebody really wants to get into it, what would the Rockefellers do? This could be a secondary book, and it explains to you, this gentleman does very well, Garrett Gunderson, talks about the difference between the Vanderbilts and the Rockefellers. And even though the Vanderbilts have a nice college today, they don't have the wealth that they could have had back in the day. And that's because the Rockefellers understood how whole life cash value works. And now they have a family bank, generational wealth. And all they do is finance everything through their policies. They don't have banks to do anything for. Just a food for thought. If you guys want those tips, that's fine. Now we're just going to go into briefly about what I do for my own. This is my own IUL policy. I'm just going to understand facts. I'm giving you facts of my policy, not what we do at AMS or whatever happens with illustrations. I'm giving you my facts. So I'm just completely biased to let you guys understand what I've done for myself. This isn't a knock on anything that we're doing, you know, internally with the company. So, but here's my policy, and I'm very transparent. Albert, you can talk to anybody. But we can see here, this is typically what an IUL does. And this is the typical 99% of people. The 1%ers that actually know how to really design an illustration where they're taking a massive cut in commission, those are different. But here you can see when we see an illustration, we're seeing an illustration. Are these numbers okay? Are these small, big, Albert?
They're a little small. If you
Okay,
can,
let's do
if
this.
you can enlarge it a little bit.
Is that better?
That's better, much better.
Good. Okay, so we can see here in my illustration I did 4 years ago. I'm 44 right now. I did it 4 years ago, and I was illustrating this. I was taught how to do this from a company and from internal wholesalers that were teaching me how to do this to run my own for clients. So when we see these things, we're running these at like I run mine at 6.9%. And you're going to see them today. There's certain limits versus the AG9, AG49 that gives us the limit where we can't illustrate higher than a certain amount now. Because back in the day in the 80s or 90s, it was just a bidding war for who had the highest illustration. We can illustrate 10%, 11%. I think I can't name the company, but one of the companies where it's just astronomical 12%, which was just ridiculous. But I want everyone to understand here in my policy, there's a current scenario at 6.9, which you guys will see. Maybe they're at 7 or whatever. And then there's an alternative scenario, which companies have to do. They have to show you an alternative of what could potentially happen, because a lot of them have been getting sued because they're just showing you a higher one versus what can potentially happen in the long run. So they're taking all of the risk off of themselves and they're putting it on us, the clients. That's what they're doing. They're shifting the risk. Because as long as they do this and someone has an illustration they're signing to, they understand the risks that they're putting their money into. Insurance company can wipe their hands clean with the attorneys, and that's about it. But you can see here, I want everyone to understand, these aren't average rates of return. There's a very big difference. This is telling you this is an actual rate of return that you are going to earn every single year for the next 60, 70 years, whatever it is. That's what it's saying, with no zeros in the policy. You understand that? Yeah, okay. So do we think around history that there won't be any zeros in 60 years, that there won't be any credits? Like this year, I got a zero this year in my account. May 21st is my anniversary date, and I say that because I want everyone to understand if they don't. When we get credited, like an S&P 500 annual point to point, Albert, do you know when someone gets credited that money in their account?
Normally every year, every 2 years, depending on how they set it up.
And do you know what day that starts on?
The contract date or the approval date?
Yeah. So a lot of agents I've been talking to, they really don't know. They think they know, but understand anything you do with 401ks, IRAs, whatever the case may be, those go through calendar years, January or December 31st to December 31st. And that's when you get credited. When it comes to anything in regards to life insurance, like an indexed annuity or a fixed index annuity, like an, index UL or an indexed annuity, it starts from the day the money goes in. And that's your point. So whatever the S&P number ticker says today, which is 3740, that is your number next year. And if you don't get a credit higher than 3,740 from the S&P next year, you get a zero. That's how it works. So it's not January to December, it's whenever the cash goes in. So understand this, when we're doing it, we don't know what can happen. This is all hypothetical. These all numbers are hypothetical. We don't know what it's going to earn. Now, I want everyone to understand, I won't get into too much detail, Albert, but our money is not inside of the S&P 500 index by itself, or any index where you share in profits of a spread where the company makes money. When we give money to the company, they take our money, whatever's in the cash value account, that money is really in their general account. And whatever they can earn in the general account, which is, let's just say 4% guaranteed with the insurance company, they know that if someone has $10,000 sitting in their cash value account, that they are going to earn 4%, which is $400. They take the $400 and buy call options. That's what they're doing. They're buying call options. And what they're doing is when they buy the call option, they're hedging against, they're getting it at a discount. And they're saying, well, if it goes higher than that option, then we'll participate in whatever it is in the index, whether there's caps or whatever. And then if we don't, well, don't worry about it. We lost the $400, but your 10,000 stays locked in, and that's your floor.
Right.
That's what happens. The reason why we have to shift to different brokerages, like a JP Morgan Mosaic, a Bloomberg, or Credit Suisse, or some other ones, is because the options have become so volatile, because there used to be only 5 companies back in the 80s and 90s, or 96, bidding for only like the S&P option. Now there's over 50 companies bidding for the same option. So the spreads for them and the margins are so minimal, and the costs are so high to get that option that they can't afford. And that's why they have to lower cap rates. Just a little bit food for thought. So I'll get into this. So understand this, guys. I paid $6,000 a year for 3 years straight, $18,000. You can see this is what I should have in my account right now. So these are hypothetical numbers, but I ran this on myself 4 years ago. So maybe if I earn 6.9, this is what it shows. And if I earn 4.75, this is what I can see. Well, I have my factual data here, which I don't care. I show it. This is how much I earned. I don't know. Can you see how much that says? I can't see it.
No, you can read it off to us.
It says $13,727. That's what I have in my accumulated value. It also says here that my access to cash, my cash value that I can borrow against, is only $3,300. So I have to ask myself, man, if my account has 13,700 right now, do I see that here? No. Did I see it here? I'm almost there, but this just tells me right now that I couldn't even earn 4.75% in a bull market for 13 years. I couldn't even earn 4.75% in this account, and I only have access to 3,300. So for me, that's tough, because I have a 2-year-old. I have a lot of bills, a lot of debt. I would really like to have access to that accumulated value, but in a UL, VUL, or IUL, we are in surrender periods where there's surrender charges. And that's why it's a long-term investment. And we explain that to them. And that's why we don't know what these numbers are going to look like going forward. So in my case, it doesn't look that good, because I couldn't even earn 4.75. I just asked myself today, what can I earn today in an IUL if I put myself into it when we're at the peak of the market for 13 years? Am I going to get in here? And if I do take a dip next year, how long will it take for me to come right back up to the top to make a profit or participate in a cap? So that's just what I ask myself. Understand this when we're looking at the illustrations. This is all hypothetical. The biggest part about this I want to go through, Albert, is let's say we just take the income, because this is all tax-free retirement. Go through tax-free retirement. It says here, based upon my illustration, if I earn 6.9%, it'll run till age 120. It's going to look perfect. But this isn't a perfect situation, because things in life are going to happen, just like it is right now. COVID, right now, they're raising the rates. They're going to raise the rates again 2 more times before 2023. The market still hasn't seen the dip that it's going to see, in my personal opinion. But now if I take the $35,000 out tax-free and I earn 4.75, you see here I got a 0. Do we know what happens when there's a 0 in our account, Albert?
Policy lapses.
Policy lapses. It implodes. And let's just say I did. Let's just say, you know what? I did pretty good. Maybe I earned 5.75 instead of 4.5. I didn't earn the 6.9, but I came right in the middle between 4.75 and 6.9, maybe 5.75. So now the money ran me out till age 80. So I put in 156,000 of my money, and I borrowed $500,000 tax-free for life from the company. But because I only earned an internal rate of return of 5.75, my policy runs me to age 80. So now what happens? Well, now I have a 0 cash value. My policy implodes, and now I'm going to get a nice big tax bill for $500,000 that I thought was tax-free, but now I got to pay taxes on it. That's what happens when a policy implodes. Just letting everybody know, food for thought.
Good to know.
IULs aren't bad, and I'm not saying they are. I have an IUL for myself. This is it. I have one for my son who's 2 years old. We made 18% return on his. So I can't contradict myself. It's just a matter of timing and design. I think I got him at the best time because he was born in December and January when I had his social security number, I got one. And his is like cyclical now. It's on from January to December. He's on the best time frame. In my opinion, that's kind of what I think. I think the best times to get into an IUL are on the dips. We just don't know when, but we can kind of guess. Anyone that had an IUL back in 2020, in my opinion, has made some money for that year or those 2 years. Anyone right now getting in, and this is my thought, I'm thinking it might be tough because if we're at the peak stage of an IUL, it may not earn anything next year. And I know it's long-term investment, but you ask yourself, do you need access to your cash? If you need access to money because you have bills to pay, you want to purchase a car, you want to go buy a house, then the whole life chassis is what you design it from. If you want long-term investment, you want to just put money into it and forget it, set it, forget it, and wait 25 years, then we'll see what happens. You don't really get access to a lot of the cash, as you can see in the first 10 years, because we have surrender charges, right? The money, where the money meets the road is, put in 60,000. I haven't even earned the 60 over here. It looks like I do, but I'm still in surrender charge penalties. So it takes me around 11 to 12 years before I can actually get what I put in. But then the insurance company has all my money and I haven't really been able to utilize it more effectively that I want. So anyway, that's just how my IUL is designed. And not all of them are designed that way. Some of them are designed really good where you can make a little bit more money. But my personal opinion, I really truly believe that all IULs average out an internal rate of return around 4.5%, maybe 5.5%. I think that's really the real number. In my personal opinion, that's the internal rate of return. If anyone understands what averages is, that's what brokers use. And I'll give you a good example. You have $100,000 and then you lose 50%. Well, then you're down to $50,000, right? Well, then the next year following that, you make 100%. So now you're back up to 100,000. So what's your end number after 2 years? Well, I put in 100, I'm back at 100, it's 0. So what's my average rate of return? Well, 100 minus 50 is 50 divided by 2. It's 25. I made an average rate of return of 25%. I did good. But my account says the same valuation as it 2 years ago. So I didn't make anything. But the average, but you made 25% average. You see how it could be like misconstrued, brokers telling you what your average rate of return. I want to know what my actual rate of return is. That shows me what I'm making money on my money. So here's a whole life. This is the way I designed my own whole life. This is my policy you guys are seeing, which I share it to everyone. I've redesigned this 3 different times. So this gives me access to my cash immediately. This is how we design a whole life policy the right way.
Could you enlarge it a little bit, please, Scott?
Oh, sorry.
Thank you.
Is that better?
Perfect. Thank you.
Okay. So you can see here on my policy that instead of the bank getting all my money and earning 0.0 something percent, I need access to it right now because I have bills to pay, a lot of them, over 250,000 of debt. But the $20,000 is earning 0. What if I reposition this money to a bank, my private bank, where I have access to it? But when I borrow money, understand I'm not borrowing my money. I want everyone to understand that when you borrow money, you're not borrowing your own, you're borrowing from the insurance company. You are borrowing their money out of their general account. They're using your death benefit as collateral, and your net cash value, I would say, is like a line of credit. You can only borrow what you have, and anything you borrow from that line of credit is subtracted from your death benefit. You're just using it as collateral. Your money in this whole life plan stays there uninterrupted and keeps compounding interest. So you never lose what you put in. You can borrow somebody else's money and go invest it somewhere else and make money on your money, on their money. So now you're really doing what banks are doing. You're leveraging the money that they're giving you to go make more money. So it's OPM, other people's money. But you can see here, you can see in the first year, like I just made a deposit of 25,963. I did semi-annually. So they have all these numbers. The check just cleared. By the way, guys, this took me 4 weeks to get from start to finish, fully underwritten. I did blood, urine, all this stuff, or ordered doctor's records from the application to now. It's completely done. Took me 4 weeks. Anywhere between 3 to 6 weeks is the time frame process I would tell people to expect. They do have accelerated underwriting from ages 20 to 55. My personal opinion, I think anyone 30, 31, maybe 33 and younger should be able to get accelerated underwriting, like simplified, like we all know. But I'm 44. I had to do fully underwritten. I'll just get people prepared of the time expectation and, under promise, over deliver. That's what I would say. So they have my money, Albert, right now. It cashed. I called them this morning before the meeting to see how much can I get. They said I have access to $22,169 out of $26,000 I put in. That's over 85% of my money, like that, without waiting 12 months for that deposit to clear and have dividends. Where can you do that? You can't. I can't do that with an IUL. Can't do that. So now I can take that money and go pay off my Macy's, Home Depot, Amex card that's charging me 17, 18, 25% interest to them. And I'll only have to pay Lafayette Life Insurance Company 5%. So I just gained that spread of interest to myself now, while my money is now still going to stay inside the cash value and compound because I'm borrowing their money. Now I just pay back the loan to Lafayette and I don't have to worry about American Express anymore at 25%. And I'll show you a little bit about what I'm talking about. But I'm just showing you guys how this policy would be run. I have a better one here for someone because people always ask me, what if I'm 22 years old or 30 years old? The numbers are going to be different based upon age. I'm just using this because there was I'm sorry if I put the guy's name, I shouldn't have done that. But if you scratch that out, just let me know. But here you go. Here's a 22-year-old male putting in $500 a month. We'll go here. Sorry. I don't want the lump sum in there. I'm sorry. I'm going to start here for you. So you have 23-year-old puts in $500 a month, $6,000 a year. You can see here after year one, Albert, they have access to $4,200. You can't do that with an IUL, right? Have you seen illustration ever look like that?
Never.
So you have $4,200 at 6,000. They can have 70% of their money right now after year one, because they got to wait every year, right? They're young, they're 20 something. They can only put $500 a month. So do I want to put my money into an IUL and wait 7, 8, 9, 10, 12 years to potentially earn that money? Because remember, I have to earn that index every year. I got to get credited in order to have an increase in compound. So these are taken into account dividends and interest. The best part about this, Albert, I want to show people is everyone is trying to ask me, what's the rate of return? What am I going to earn? In a whole life chassis, it's not what you're going to average or this and that. It's what is my money going to make on my money? It's a real estate term, cash on cash return, right? If you give me $10,000, but I give you $12,000 return at the end of the year, what was your cash on cash return? You made 20%, just like that. The beautiful thing about this is you look here in year 6, right? The guy still puts in $6,000 that year and gets credited $63.45. Now, every year after that in year 6, every time he puts $6,000 in, it will never be below his initial deposit. It will always increase because he's getting compounding interest on the higher net cash value. It's always going to compound at the higher valuation. So 10% of $6,000 is $6,600. Well, let's look at year 7. Year 7, he puts the same exact $6,000 in and he gets credited $6,700. More than 10% return on his own cash. And guys, it just keeps climbing after that. And understand here at 28 years old, if the kid has $26,000 in the cash and he wants to borrow from it to go buy a car for 25 grand, guess what? You borrow the 25,000 tax free. You go pay for the car and then you pay the insurance company back for lending it to you. And whatever you were going to pay the 5-year note, just use that number and pay them back, because you're going to pay someone else. You're either paying interest to other people or you're going to gain the interest back on yourself, guys. That's what it is. The company's Lafayette Life Insurance Company. What is the non-guaranteed? So understand when it says non-guaranteed, every assumption is non-guaranteed. They have to by law, but we're talking about dividends, Albert. What I mean by that is I'm 97% certain that I'm going to get a dividend every year because we're using companies that have never missed a dividend through recession. So why would I think otherwise? Why would they stop now? You see what I mean? So they have to say non-guaranteed. but I'm going to take this illustration as it is. It's not hypothetical, in my opinion. Right? The dividend can be higher or lower depending upon the year, and that's why they can't tell you it's a guarantee. Okay. But anyway, you can see here, rubber meets the road. Around here, it was around year 10, 60,000 of his own money goes in, 61,000 is his net cash value. It will never be below that valuation. Every year after that, it will always be a profit on his own money. So I got to ask yourself, why the heck would I ever stop putting deposits, premium in this account if I know every time I put money into this, I'm always going to get back what I put in? So I'm just giving you guys an idea of how to utilize whole life the correct way. I'm going to shift gears. You can use it for a car, Albert. If somebody doesn't have debt out there, they just want to use it for a car. I just did this on the whim, but maybe someone 35 years old, I'll blow it up. I'm sorry. So you see here, someone who's 35 years old wants to buy a car. Just using this concept for a car, Albert, just a car. Someone that has 20,000 sitting in their bank doing nothing, we can design it where 10,000 a year goes in for premiums, and he just throws the extra 10,000 as like a lump sum. So understand, your policy, your whole life policy is a rocket ship, and your rocket ship's trying to get off the ground, and it'll still go. But if you attach boosters like a lump sum front load, it's going to shoot right off. It's like a policy on steroids with this guy is like 300 pounds. I was doing this illustration. It's like a policy on steroids. I go, yes, whatever it is. I don't want to mess with you. So that's what it is. Taking into account, the guy does this at the end of the 5th year, he has $58,000, and now he borrows 50,000. Right? Borrows 50,000 from the insurance company. The 58,000 stays locked in a vault and just compounds because he's not using his money. He's asking the company to borrow their money, and he's just going to use the death benefit as collateral. That is it. So if he dies, then they will subtract that loan from the death benefit, and the proceeds go to your beneficiaries. But you can see here, if you were going to get that car for 50,000 in 5 years, understand that what you were going to pay $11,800 a year to the BMW, Lexus, Mercedes dealer, whatever you want. Instead of paying them interest and all this stuff, pay yourself back and earn interest and compound at the same time. So I just did this for someone to do it every 5 years. You can just finance cars every 5 years using your own policy. You know, and I didn't go any further, but you get the concept. After 58 years old of paying your car, you got 3 cars, and your cash is up to $335,000. I mean, let's say at that point in time, I want to go buy a house for $300,000. Well, now I can borrow the $350,000 from here and go buy the house and pay myself back instead of Bank of America all the interest. There's a lot of things you can do with this policy. I'll do one more thing, Albert, because I know your time is valuable also. Let me answer this question. Don't have to pay interest on a loan. Yeah, you don't have to pay interest back on the loan. You can just let your death benefit pay it. But if you're your own banker and you guys read that book, you'll understand what I mean. If you own your own bank, don't steal from yourself. Pay yourself back, because the more you can pay your policy back, the quicker you get access to the cash again. If I have an outstanding loan and it's just growing at 5% of whatever it is, it's fixed, but it keeps compound, it keeps growing on the loan, then I can't borrow enough. I can't borrow more than what my loan is based upon, the cash value and the loan value, the net. So I would just pay my loan back, but you don't have to pay it back in the first year. It can be 10 years. It can be, you design it however you see fit, your repayment schedule. It's not where you go to the bank and the bank tells you when you borrow a loan out for 20 grand, you got to pay me this amount of money and you got to pay me this, and you got to provide me with your W-2 and we're going to do a credit check. You don't have to do that with life insurance, Albert. You just call them up and ask them to send you one form. There's no credit check. No one's going to run anything. I don't need a W-2. They just ask me, do you want it wired or you want a check mailed to you? That is it. You get access to your money within 3 to 5 business days. This is the program that we use just to pay off debts. I'll go into it briefly, but you guys, if you saw the video, this is what we did. This is my own personal stuff. I use this to find the right program. I run briefly through it. And if anybody wants it, Albert, the site for this is debtfreewithibc.com. They don't have to get it if they don't want to, but if they want to utilize it, they can. I'll put it here in the chat.
Perfect.
It is a cost.
Okay, great.
It's not mine. I just found this debtfreewithibc.com. I just found this a while back and I brought it to Sean and he said, well, why don't you just show it to everyone? If it worked for me, then why don't you show it to everyone else? Here's my debts. I'll run quick because I'm short on time for you. Am I good on time or what do we have?
No, we're good on time. Yeah.
Okay.
No rush.
So the software program, what this does is it allows me to put in all of my debts. And then what it will show me is where am I using my money inefficiently? Where can I start repositioning the cash that I'm already doing in the household and recapture it so that I can create a policy to put in place for myself? That's what this program does. So you can see here my house, 178, 3.5% interest. I'm paying 814 to just principal and interest, just P&I. But I have some people that overpay that. They want to pay more because they want to bring the 30-year down to 25 or 10 or whatever it is. Understand, you're not changing the payment. The payment's still staying the same, right? You didn't just shorten the payment stream. It's still going to be the same 814 every month. All you did is trying to shorten the time frame. So stop doing that. You're just giving the banks more interest because in the first 7 to 12 or 15 years, you're just paying interest anyway. And they know it over the history of everything, over 100 years. They know people are selling their houses more and more every 7 to 10 years anyway, because it's not like the older days where people came home from the war and they created a family, made some babies, and they lived in the home for 30 years. It doesn't happen today. People are selling and flipping homes constantly, and the banks understand what's going on, and they're capitalizing on it by charging you interest up front. So here's all my debts: Macy's, Home Depot, Amex. I won't bore you with that, but you can see the interest rates here, and you guys can watch it back on playback. But this is the minimum payment. We get a statement from American Express. You got $10,000. We want $182 a month. But what do? We pay 200, we round it up, or we pay 300. We try to knock it down a little bit more based upon what our income and expenses are. We just try to give a little extra. Well, why don't we stop doing that? Why don't we stop doing that? Because that is an inefficient way of overpaying for something we're never going to pay off anyway. So what this software does, it shows you where the inefficient overpayment is, and we just redirect it up here. And now you're building your own life insurance policy. You're building a premium of where you can put towards this, and you're just redirecting where your cash flow is going. That's all you're doing. I'm not telling you, let's come up with new money. I'm saying, let's see what you're currently doing in your household, and let's move things around to come up with a better solution. Some investments here, savings. If someone has a 401k, IRA, it's a very touchy subject, and I don't want to get, I don't give advice for stuff like that. I can if it's a one-on-one. But this is what I got to ask you. If you're contributing to a 401k because your boss is giving you a match and this and that, understand those weren't designed for us. They were designed for business owners who had 100, 200, 1,000 employees where they can collect all that contribution and write it off to business. This is a book my friend had, 7 Mistakes for a 401k. And the guy that invented the 401k, DeBena, he got it wrong. He even said he got it wrong. And his new plan, the 501 plan, is actually through whole life cash value. Not IOLs, by the way. That's what he says. But you guys can research Ted. I think it's Ted Bena is his name. He was the creator or designer of 401k. He said he even got it wrong. But understand this. You've heard the term, would you rather pay tax on the seed or the harvest? Think people have heard that phrase before? If I'm going to pay taxes on the harvest and it's a 401k and I put in $10,000 a year, well, would I rather pay tax on 10,000 or 100,000 later on, or $1 million? And that's what you have to ask yourself. Uncle Sam is not stupid. They know that over time, they'll let you defer, right, your taxes. And then when it's time to retire in your 60s, you think you're in a lower tax bracket, which you're not. And now your investment is $500,000, which you're going to have to pay probably 35%, or the IRS will ultimately receive 35% of your money. Guarantee they're going to get your money, a portion of it. So what I'm saying now is, why don't we stop doing that to myself if I had one? Let's stop doing that today. Pay tax on the $500 a month or $1,000 a month that we get from our check, and go ahead and put into a tax-free, vehicle, so to speak. You can't. 2 things I want to make clear. People are already asking me. You cannot put a taxable account into a tax-free vehicle. You can't go 401k to life insurance. And if you do liquidate any money from your 401ks or qualified accounts, we call them, you're going to be assessed a 10% penalty. If you're not 59 and a half and younger, you can get assessed a penalty of 10%. Plus it's counted as ordinary income tax. So just understand that when you're talking to clients and they liquidate stuff, you don't want to get your hand caught in the cookie jar on that one.
Does that also apply to an orphan 401k? Like if they no longer work at the company, that they're still assessed that 10% penalty?
Yeah, any retirement account, whether it's an annuity, anything annuities or retirement accounts, even when you put money into it, but IRAs, 401ks, 403bs, 457, TSP accounts, anything that has not been taxed yet will be assessed a 10% penalty. There are some waivers, like during COVID and stuff like that. I think they were waiving the penalties for hardships. I think there are ways to do that, but I'm just talking in general. If we don't have hardships and this and that, I always have the geniuses out there that are trying to tell me, yeah, but I can do the same thing with my 401k. I can borrow that. I can borrow from there. Yes, you can borrow. Who are you paying the interest back to? Fidelity, Charles Schwab. Okay. And didn't you just lose 15, 20% this year also? Yeah. Okay. So you lost the 15% and you lost the 5%. You got to pay back the loan. Oh, and if you get fired because you lost your job, you did something stupid, or if the recession hit and they let you go, you got to pay the whole thing back. Do you want that vehicle? So I'm just giving you some different ideas of the 401k, but there's other ways around. I can design some plans also where I can get around the 10% penalty, not so much to help them come up with a premium. I can go into detail that later, but let's just move on a little bit with this income we have here. Whatever you earn, I was always doing something $200 a month where it was from like 18 years old. I was just moving, checking to savings. It was on autopilot. I forgot I was doing it. I found it and I said, forget that. I'm going to add that towards my life insurance premiums. I have my IUL. You guys see here. I'm not contributing 500 anymore. I'll drop it down to 250. I'm still going to keep my policy because I don't want to lose the 13,000, right? That's the 10% spread, the 10,000 spread. But I'll just pay the bare minimums right now to keep the death benefit alive. So I'll just do that temporarily. So now I have my report. Now you would take the report, right? Oh, and I took the 20,000 from my savings, you see. But some people can have $50,000 in the money market account that they say, well, I only want to test this out with 10,000 or 15,000. Okay, well then that's your redirection of lump sum out of your savings account into your new privatized bank of a whole life policy. So this design now shows you where I'm going to call, send something into the AMS team for infinite banking for me. Hey, Scott, I got a 44-year-old male, standard non-tobacco, wants to put $1,000 a month in and $20,000 lump sum. Can you please run me an illustration? Got it. Send it to you. This program allows you to upload it. It already has it integrated where all the data is in it. You don't have to copy paste nothing. It does it for you. You can do different effects here or customize. You want to pay the snowball effect, avalanches, different names out there. Pay off the principals and the lowest principals or the highest interest rates first, whatever you want to do. Or if you share one of these with someone else, a family member, you can just customize which one you want to pay off first. But this is the best part. This is what got me, which was insane. So if you guys follow along here, you can see the green reflects the green. That's the debt action plan. And the blue reflects my current plan right now. If I never even heard of this strategy before. So if you follow along, you see, I only want you to look at this, the cash value column and the loan value column and the total assets. That's how much cash value I have available. That's the loans outstanding, and whatever's left over, I still have access to it if I want to. Okay. So you see here, I put the money in 30 days time, I'm going to borrow 16,400. My numbers are changed because I changed my illustration, but I'm just using this currently. But you can see here, 16,400 after 30 days of having this policy. Well, what do? I take the money and I pay off Macy's, Home Depot, and Amex. I am done with these creditors. They're not getting 25% from me anymore. I'm just going to pay 5% back to Lafayette, and that's it. While my money still sits in the cash value account and will compound, earning uninterrupted interest. Now, whatever I was paying Macy's, the $70 minimum, Home Depot was $30, and American Express was $300. So $400 was my minimum that I was paying them anyway, right? I was going to have to write the checks no matter what. Instead of writing 3 checks to them, I'll just write 1 check to Lafayette along with my $1,000 premium. So they're getting $1,400. Okay, 1,000 is going to my premium, 400 is going to pay back the loan. We understand that so far? Okay.
Mhm.
So now I want you to see as I move every month along the column here in the bar, you'll see the cash value goes up and the loan values go down. So you can see here as we flow through it. Now, when I get to year one, and I think the next loan I have to pay off right here, Albert, you see it's a little small, but it's the MasterCard, which says I owe 14,628 and I have access to 16,382. So now this policy will tell me it's time to take out my next loan. So now I borrow the money. I write the check out to MasterCard. I no longer pay MasterCard. I just write my new check minimum to Lafayette. Now I have a lot of geniuses out there that say, Scott, you didn't do that. All you did was you borrowed money from one place, you paid off another one, and you still owe money. I said, yeah, but understand this, Albert. I can cancel this policy a year and 3 months if I want to, walk away clean, throw it in the trash. And guess what? I have Macy's, Home Depot, Amex, and MasterCard completely paid off. I don't owe them. And the insurance company will still write me a check for $5,400. So what did I lose? Right? What did I lose? I don't have to pay them anything, but I want to because now I know how this thing works. I know what compounding interest is. So the next loan that I need to pay off is really my auto loan. Now understand this, Albert, this is my car in the parking lot that I'm gonna have to buy out. My BMW is up, the lease term is up, and I'm gonna have to pay for it because I'm gonna buy it. It's $30,000 next month. I got to get a loan from a bank. But that's $30,000 I'm gonna owe them. It's a 5-year note coming. So watch how beautiful this is. I keep paying my premiums, and about 2 years going, I have $25,254 available to me in my cash. Now my auto loan at that time is going to be $21,793. So now I have access to borrow this money. So what I want you to understand here, guys, is in 2 years and 2 months, I just paid Macy's, Home Depot, Amex, MasterCard, and a 5-year car note in 2 years and 2 months. Done. Using uninterrupted compounding interest and just paying myself back. I don't care if my car is 0% interest for 5 years. It doesn't make a difference. I just paid a 5-year car note in 2 years and 2 months using this whole life policy and compounding interest the way it should be done. So I won't bore you with more of the details, but you can see here the next real debt I have is my house. It's $170,000. But as we get down here, Albert, in year four of doing the same thing, I'm debt free with all the loans wiped out, and I have $60,000 available. If you have any questions, just throw them in there, guys, at the same time. But my monthly is $1,000 a month. I think somebody asked me. I'm paying $1,000 a month. But all these minimums that I was paying before, Albert, they are now going towards the loan, that big loan. And that's where 4 years fast forward, I've done with the loan, I've accumulated my wealth, and I still have access to 60,000. But the next debt I have is my home, my 30-year mortgage. My 30-year mortgage, I still owe $163,000. Well, I only have 60,000 available, but maybe my wife wants a car in the 4th year. So maybe I borrow 40 or 50 grand from the policy if I have it and pay the policy back. I can do that. And I still have my money compounding. But let's say I don't do that and we get to year 7. Well, by the time I get to year 7, that's pretty beautiful. Everything is completely debt free.
Wow.
I paid off all my mortgage. I paid my 30-year mortgage down to 7 years, and I have no more car payment. I have no more debts with credit cards. Now I do owe this loan back. So I guess I do have a debt. But Albert, guess what I can do? Can I just walk away from this policy after 7 years if I want to and never pay a loan back? Because I have cash in there.
Yep.
So I can walk away in 7 years with my house completely paid off, my car is completely paid, all these credit cards done, and they'll still write me a check for 13 grand, tax free. That's not bad for 7 years. I'd say it's pretty good in my opinion. But when you understand how you can utilize whole life this way and designed this way, then you can take advantage of it. Now it's all just free money. Now all the money I was putting towards the minimums of everything, I'm just going to pay this thing off as quickly as I can, because the faster I can pay this loan balance back, the quicker I get access to whatever I want. So the best thing about this is, let's just say in year 9, right? I have $100,000 available in my policy, my bank, my privatized bank, Scotty's bank. But now let's just say that there's a duplex that I've been eyeing on, waiting for the market to do what it's doing, and I want two homes, two duplexes, 250 a piece, 500,000. That's what it's going to cost me. And I go to Wells Fargo and I say, hey, look, Wells Fargo, I need $500,000. And they go, well, we need collateral. Can't just give you $500,000. Say, all right, hold on 1 second. I'm gonna go to my Lafayette Life Bank. Hey, Lafayette, can you please wire me $100,000? Right. So now I go back to Wells Fargo, a little update, and I give them $100,000 of the insurance company's money, not my money. They're getting Lafayette's 100,000. And now I say, here's 100,000, 20%. So I have to pay PMI, right? Private mortgage insurance. So now they give me a $500,000 loan. Now I have the house. Now I do have the conventional loan for Wells Fargo, and I do have the loan from Lafayette. But who cares? I get renters in there that are paying me $100,000 a year, maybe. Let's just hypothetically say. And now that $100,000 a year, I'm going to have them pay back Wells Fargo's conventional loan and Lafayette's loan, and my money's going to still compound. And if there's any money left over, that's surplus passive income. So now I'm using other people's money twice as an arbitrage. I'm making money on my money. There's people out here that do hard money lending or private lending. I'm not going to advertise that, but there's people that can take $50,000 out from their policy to go lend to somebody at 15% and earn the 10% spread. Right? If the loan is 5% and we loan it out at 15, we're making 10% spread. Now you're using an arbitrage. So you're using your money as leverage. Do whatever you want to do. So that's how beautiful you can do this program. My plan, 29 years and 3 months. Following through this whole program, I'll have $1.4 million tax-free money, do whatever I want. Now, if I want to take tax-free retirement at the end of this 30 years and I'm 74 years old, well, then I'll just take tax-free retirement from my own whole life. If I want to, I can do the same tax-free retirement through my whole life that I can still do with my IUL. The difference is I just don't know what the heck my IUL is going to do in the next 30 years. I don't know what it's going to earn. And the cost of insurance in my policy is much lower because it's the same cost that I had at 40 versus 74, because it's whole life level for level, not increasing. I'm going to show you the report here, and then I'll answer any more questions. This is the report that this gives you. It's a nice little report. It has my company. When you get the program, it's $150 a month, Albert. There may be a discount on there for 10%. I don't know if everyone took it. They can get it if they want to. They don't have to, but it's month by month, no contract. I'm not advertising it. If anyone wants to get it, you get it for yourself. But you can see here, this just gave me the option of collecting $72,000 and gaining the interest for myself while paying off everything in 7 years and 1 month. This was my current plan, my debt action plan. You can see here, you want to identify your inefficient payments, overpayments. You want to start making the minimums as much as you can, and you want to build that cash and take out loans to pay off your debts and then pay it back. It just shows you the redirection of funds. And also here it shows you all the interest that I've been paying, all the monthly payments. So the minimums were $2,600. I was paying $3,200. I was overpaying the extra $550, I think is what it says, that I just redirected towards my policy. The best thing about this program is it tells you when to take your loans. First month, 1 year. And then by that time, you're 7 years. Now, people do tell me, well, Scott, you're going to be using the card anyway, because we're human. We use our cards. We're still going to do things. Well, right. So then you go back in the program and you amend it. Or what I did, Albert, my MasterCard isn't really 18,000 or what, it was really 9,000. I forecasted an extra 9. I built in another 9,000 because my wife and my son, she's going to use the card. So I just play with the numbers. If I put 20,000 extra into the credit cards, how long will it take me to pay it off? So you can do whatever you want when you're designing these. I just forecasted an extra $9,000 built into my plan to see what it would be like. But this is my plan at 20 years, fast forward 30 and 40. This is what you can see my numbers. If I do these things, this is what my plan is going to look like. So guys, you got to ask yourself, would you rather live debt-free, stress-free today, enjoy your money, utilize your money for purchases or whatever you want to leverage in investments, knowing that at 70-something years old, I have completely no debts and I get to use my money for whatever it is coming in. Social Securities, other investments I have. Maybe I take some money from my IOL. Maybe I take money from the whole life, depending upon how the investments work out. And maybe I have other real estate properties that give me passive income. So that's the lifestyle I want to live. Or it's the lifestyle of, well, there is an opportunity 25 years fast forward with this other vehicle, IUL per se. And then you're getting $200,000 a year for the rest of your life, which is good. But then I have $1 million of debt, right? I got a mortgage, I got 2 cars, I got student loans, I got kids in college. What lifestyle do you want to live? Me personally, I want money today. I want to utilize it today and throughout the next 30 years. So your options are going to be, sorry, let me answer some questions here. Who's our target market clients? So the clientele we're looking for can be anybody. It all just depends on what they're trying to utilize these programs for. This one niche that I'm showing you is for people that have debts or people that are going to want to lower and pay their stuff, their debts down in 10 years or less. That's what I tell people. Hey, look, if there is a way to pay off all your debts in 10 years or less while building wealth tax-free, would you be interested or open to see if you fit this program? It's a good question. Just ask them that. And everyone out there will want to. Then you have the people that say, look, I have no debts. I make $300,000 a year. I don't have any debts. I put money to my 401ks and max this and max that. I pay cash for my cars. And understand this, guys, if you pay cash for your cars, you have to build up that cash to pay for your car. So as you build it every single year for 5 years and you got 50,000, you don't have it anymore after the end of that 5th year. Now, how long will it take to replenish that 50,000? 5 years, 6 years? And you're going to lose what's called the opportunity cost of compounding interest for those 5 years. So you're just doing the ladder and then zero, the ladder and then zero, while your money is not compounding. Instead of doing that, reposition it to the whole life program and now utilize the function of compounding interest the correct way. You can do that for real estate. I got a program right now going on with the real estate for a client that wants to dump in 400,000 out of the 800 into the program of a life insurance whole life policy. And we can go ahead, once we do that, collateralize that with a third party lender bank where they can give us access immediately up to 75% of that money, over $390,000 of a line of credit to go purchase properties and use that as leverage. That's very different than this is, but I'm just showing you there are many different ways of utilizing this. One for debt, one for real estate or developers, or anyone out there that wants to get money now to utilize. You can utilize this just to purchase equipment or purchase cars like I just showed you. You do whatever you want to do because this banking function is just like having your money in Wells Fargo. You're either going to build your bank slowly and small, or you're going to supercharge it. And the ideal start, in my opinion, would be maybe $250 a month and $5,000 minimum to supercharge this thing and really jumpstart this puppy and get it going. Because then you really get access to cash. Let me see this one thing. I'm sorry, Albert. This might make sense. Where was this one? Was it Parker? Yeah. So this is a good example of someone who's 22 years old that has wants to put in $300 a month or $317 a month, and has $10,000 just sitting in the bank. Maybe he got it from birthdays, or maybe he just got some extra cash savings, or he got a bonus or something. But if he repositions the $10,000, you can see how much it supercharges this thing. Rather than just paying $300 a month, he just boom throws in $10,000 at the same time, and he's got $12,536. And if you do the math, it is unbelievable what this looks like. 12,536 divided by what did I say, 13 something. Say 13,000 as an example. So he's got access over 95% of his money. 95% in the end of year one.
Wow.
You can't do that with an IUL, can you?
Nope.
Okay, everyone's asking me really about the commissions. That's really where they want to go.
Well, before we get to the commissions, can I ask you a follow-up question?
Yeah.
So like so depending on the type of leads that people work, or they just think like, hey, this is a great concept, Scott. Everyone wants to do this. If someone has like $30 a month or $100 a month or living paycheck to paycheck, this is not applicable to everybody, correct?
No, I'd say just sell them an Americo or any other comparable or MU, the IULEs. something like that. If you can get $100 a month into the IUL, like NLG or whatever we have, F&G, North American Global Atlantic, for that, and it's doing that, yeah, that's probably for them, because the way we design these policies,
Right.
Albert, you have to have enough room between the death benefit, to maximize the cash equivalency of maxing out your policy. You can do that with an IUL because you're just lowering or increasing the death benefit for the target premium on an IUL. The way we design a whole life, we're talking about these three components.
Yep.
in a whole life chassis, where we're saying how much death benefit can we buy, the minimal amount we can, and how much can we overfund it to the max that the IRS allows us to. And the only way we can do that is what we call a triage, or just think of it as like a trifold, right? Three different sections. One is the base policy, which us as agents will make commission on, majority stake of it. The bulk commission comes on the base. So you can see here in this situation, we have $25,000 is the actual death benefit. That's the death benefit. So how do we bring it up? How do we bring the death benefit up where we can stuff $213,000 out of this money into the cash account and pass the 7-pay test? Well, we have to attach what's called a rider, and we have a term rider. And you know about terms, it's the most amount of death benefit for the least amount of money. That's a term. So you can see here, it's only going to cost $26 a month for $250,000. So now if you add those two together, we have almost $300,000 of life insurance death benefit that we can go to the IRS and say, well, he's got a $300,000 death benefit. Now we can overfund $213 into the cash account.
Got it.
And they call it a paid up additions, PUA. We're paying up an addition to the actual premiums. We're just buying more insurance. And that's how we're able to pass, right here, the 7-pay test.
Makes sense.
Yeah, so it doesn't. So that's like the number right here. And this is, in this scenario, I gave the guy plenty of room where the minimum he can contribute, the bare minimum to this policy is like $114 a month, like $1,300 a year. But the maximum he can contribute is over $12,000 extra into the policy. So he's got $14,000 room to do whatever he wants. Maybe he gets a bonus check. But it's $300 a month, $3,600 a year, or up to $14,000 every year if he wants to add more cash into the account and really just supercharge it. Did I answer the question a little bit?
Yeah, absolutely. My guy Yoel here had a question too. We know we can front load and put in a lump sum to supercharge it. Is it also similar to an IUL that it's a flexible premium and that you can put in a little less later at certain points, or is it a fixed premium going forward?
So when it comes to this, how we design them in this scenario, it's whatever we have contributed in the first 7 years, whatever the average is in the first 7 years of your contributions, that will dictate how much you can put in from years 8 and beyond.
Got it.
So if you put in 14, if this person puts in $14,000 a year for the next 7 years, that is his new number from 8 and beyond, 14 grand. That is his number. I haven't seen the IULs about this, but if you do a lump sum with the IUL cash account, you're just going to get access to whatever you put in as the cash account. I believe the net cash value amount is still going to be reflected with the surrender charges based upon your premiums every year, how you illustrate it. If it says 0, but you put 20,000 in, then you're what? Just borrowing the 20,000 with the IUL? Is that how it's working?
Yeah.
No? Yeah. Oh, no. I was asking.
Yeah. I didn't quite follow. So.
Well, I'm saying in the IULs, what you're saying is,
yeah,
if you're going to borrow money, you're saying you can also put in a lump sum to the IUL. Can you still borrow the same 20,000?
No, I meant, is it a flexible premium in that, let's say it's 6,000 a year, and then next you made some poor financial decisions. Next year you don't have as much to put in. Can you lower it to like 3,000? In
this scenario, the minimum on this policy will always be $114 a month instead of $317 a month. See, what you're doing is you're only paying, you're just paying the cost of insurance for this policy is like $100 a month.
Got it.
The extra cash you're putting in is the overfunded cash, but that's all your money. That's like putting it into your money market account. That's just all your cash, right? And then all of that comes in together to the cash value account, and now it just compounds every single year. Yep. That's how it gets built. But yeah, the minimum, if in a hard time for me, my policy $12,000 a year, if I come into a hard time next year or 3 years going forward, the minimum I can contribute is $2,200 a year instead of 12,000. That's my minimum. That's just the way that I design mine. But every design is going to be different. And that's why understand when you're dealing with whole life, you have to have someone that knows how to structurally engineer this thing properly, you know, because that's why we have to get around the parameters. But that's basically what it's about. I'm trying to answer some of these questions that Carrie illustrate portions of the software. Yeah, the software tells me whether I can or cannot go to up to the MEC limit. It tells me all that. If you have a credit card with a 0% promotional rate, the software program will allow you to put that in the 0% rate to defer it. But even if you have a 0% rate, you're not earning money on your money. Does that make sense? If your money's put into a program where you know you're always going to compound, even if you have a 0% interest rate somewhere else, it's not going to make so much of a difference because your money's not growing anywhere. You're just contributing to a 0% installment. Right? You know, how much of that $200 to student loans at 0%, how is it going to get paid back? How many years are you going to get to pay it back? Is there a minimum? Are you overpaying on it? If you're overpaying, stop doing it. Just put it somewhere where your money is going to always compound at a higher valuation. Leverage your money and then borrow from the policy. Yes, you can get money selling your own policy. I just got paid on my own policy yesterday. So yeah, if you want to write, I always say to everyone, get your own policy, because how can you sell something you don't even have yourself? I mean, that's just my own thing. I talked to a couple different people out there that sell IULs, but they don't even have an IUL, and they've been in the industry for 7 years. I don't get it. But that's just that's just me, man. I'm sorry. Any other questions? I'm trying to think of anything else.
I got one more question. I mean, so let's say we run into a client, you know, we see them, we're like, hey, this is a perfect scenario for them, but they have health issues. You know, they got diabetes, high blood pressure, they're a little bit overweight. I mean, this is fully underwritten, right? So I mean,
yeah,
in those cases, is this feasible? Is this something that?
Yeah, no, great question. You guys can go ahead. I'm going to put this in the chat for you, Albert. I'll give you a contact that I have through Lafayette. They can go here, ask LLICUW at LIC.com. They can go here to the underwriter and ask a question. Just ask them, hey, look, I have a 38-year-old male or 50-year-old male, non-tobacco, takes diabetes, on metformin or AC1 levels or whatever it is, are this, or someone had cancer 5 years ago. It was prostate or this or that or breast cancer. You just give this is a direct link to the underwriter. Just tell them what you have. And if they give you any issue, just come back to me and ask me and I'll send it for you. Good question though. What I would recommend to that is, let's say you have someone that's in their 40s or 50s that's looking for this, and they're a developer, real estate developer, has a lot of money, or they're just a regular Joe out there looking to get a policy for themselves to pay off debts. I would say, look, you have a spouse? Do you have any kids? So now you can go ahead and put the life insurance policy on them. You're the owner, they're the insured, you can fund it. And if you have a younger spouse, good for you. If she's a female, because, you know, females actually have the better rating anyway. They live longer than us.
Right.
But then, yeah, I have a policy. I'm going to get a policy on my wife for this. So I call a whole life, these programs, branches, bank branches. So in my lifetime, I better have at least 9 branches, just like every other bank has a branch on the corner, because I want to utilize all these different branches as much as I can and loan from any of them that I have access to. That's my private bank. I consider premiums deposits, because every deposit I put into my account, I'm going to make money on my money. So I just consider those. But I would say, see if the spouse can be the insured. You're the owner. You control the whole policy. They don't have access to it. You do. But now you're going to be doing a benefit for yourself, the family, and for them, because when you pass on, you may not have a death benefit tax-free that goes to them, but you have built a bank, a tax-free bank for that spouse or that child. And going forward, that's going to be a hell of a lot more than just getting a tax-free check. And then you have to start a plan. And we don't even know when you get a death benefit, you can even be qualified to start that plan. Does that make sense?
Absolutely. So
yeah, I would say every client should have their own policy. We can work around strategies for the to work around uninsurable. I would definitely get contracting here with I would say you guys can go ahead and go and contracting. Contracting at fflams.com.
Yep. And we have our own
And
contractor department. So for anyone out here watching, if you
Yeah.
need to get contract with Lafayette, reach out to Joanne. Make
Yeah.
sure the uplines are all contracted first.
I would say, Albert, you'll get more traction with copying me on it.
Okay.
And you guys can copy Scott at fflams.com. Keeps me in the loop, but also if you send it to contract, let them know, hey, look, we just had a Zoom meeting with Scott for IBC. We need to get contracted for Lafayette Life Insurance Company. Can you please help us with that? And she'll know that we have things going on, that we talked.
Sure.
Right. So
and only do this if you guys actually have business you're about to write. I mean, let's
Yeah,
prioritize it accordingly.
Yeah.
So
correct. Let's not bombard her with people that are just going to get it and not do anything with it. We've
Right.
done that before. Yeah, you could get this on children. My son's going to have one eventually over time. Understand it really works for someone maybe I would say 13, 14 and older, because juveniles sometimes they look at it as a risk, even though everyone always says, I'll just do it on my son that's 2 years old or 7 years old because the cost of insurance is going to be low. That's what they say. That can be further from the truth. It doesn't work that way. When you're a juvenile, we don't know what you're going to do. The insurance companies don't know what you're going to do. You can do some crazy stuff. My kid jumps off the freaking couch with no pillows or anything. He's nuts. It's my wife. But anyway,
and there's probably max coverage too, right? There's probably a max.
Yeah. Trust me, she knows. Yeah. But understand this. Juveniles are growing up. The insurance companies don't know what they're going to do. And that's kind of teenagers. They just don't know. So it's a very big liability. I will say juveniles, I think 10 years or younger and 9 years or younger may be more beneficial for an IUL because they don't need the cash right now. And my son's in the international index. That's why we made 18% last year. And that's why I'm not biased to an IUL. I just think that it has to do with timing, when we should get someone in and when we should look at our accounts. The average consumer is not going to look at their IUL every year to see what it's going to do. We as agents have to be more responsible to do that. It's just what I've been doing for the last decade. I'm always on touching my client, no matter what, right? Whenever, every quarter to find out where they're at. Where do they have new money? What's going on in their lifestyle? And that's just kind of what I've always done and I was taught. But that's just something you have to do as agents. I think really we're going to see the numbers from COVID in 2020, what the market's going to reflect. I think we might be somewhere back to that. And I think when we get there on the dip, that's probably the good time to pounce on IUL, in my opinion. I think the end of 2023 is where I'm going to put a little marker alert on my phone to see where the market's at. And at that point in time, I might start introducing IULs for my friends. But right now it's tough for me because we've been on a 13-year hiatus right now,
right,
since 2008. And if I get someone into an IUL for myself, my friends right now, I don't know what's going to happen. Sure. Because if I got a 0 today on May 21st and I get someone in today, I don't know what they're going to get next year. And if they get a 0, once I hit print on my IUL illustration, it's wrong. It's all wrong but it's just used for hypothetical. That's all I want guys to understand how these things work. Get more education, read up on it, get some books, call me if you need some help. There is something that Sean and I actually did go into, Albert. One last thing is at the end of our video about splits, and I'll work with you. If anything happens and you need me to talk to your clients and get on a Zoom like I've done already for the last month with agents, because you don't understand how to position it or sell it, you bring them to me. We'll get on a Zoom. We'll do the illustration. I'll show them everything. My split for stuff like that's 25%. That's all I take. You guys get the whole 75% for just sitting there watching, educating, training, and all this stuff. And then I want you to do it yourself. I won't have enough time to do this. Albert, you know how busy AMS team is with all these tickets. Right. I won't have enough time. We're going to come out with more content in the next upcoming months. But I want you guys to be aware of, look, it's not for me to take a cut or anything like this. I'm doing it so I can help you, educate you. And that's just my time is valuable, just like Albert or anyone else's time. And that's just the split, 25 to 75. I think it's pretty fair. Some guy wants to give me 50%. I did the whole thing for the 400,000. I said, whatever you want to do, it's up to you. I'm just telling you what it was for me. But anyway, that's yeah. If you guys need me to have questions about something, just go to fflams.com. Scott at fflams.com and send a ticket in if you need to at Ask the Specialist for IBC. And what I'm looking for is give me a little comments about this client is looking for X amount of dollars per month. And if they have money sitting in the bank that they want to supercharge this policy and get access to it quick within the next 30 days, like I did, then just put that in the comment. And then I'll work out an illustration and call you. If you guys want income, because I see some income, Albert, I want to put it in for 25 years and then I want to see what income looks. This is not an income concept. This is a banking function. This isn't, you can do tax-free retirement inside of the whole life, but you're using it more as a banking function where you get to use it while your money grows. And then such time in your 60s or 70, it will supplement for tax-free retirement, whatever you need to.
Right.
That's just what I'm trying to get across.
Oh, this was tremendously helpful, Scott. I mean, it was very informative. I knew very little coming into this about the IBC, and now I have a much better understanding about it. Obviously, there's still a lot of work to do, which is great to know that you're in our corner and we can reach out to you and you'll continue to be a resource. I'm gonna go back and watch this training a couple of times myself.
Yeah, it's a lot. It's a lot. I'm sorry. It's a lot to get into. The two differences to take away is, look, will you make more money selling an IUL with target premium? Yes. You will get more as commission. Now, if you want to give back to your client, you're going to take a little bit of a hit. So what I tell people, Albert, is you're looking at anywhere between 45 to 60% commission out of an annual premium. So if someone's paying $10,000 a year, just anticipate somewhere around 45 to 60% of that premium, $5,000 out of the 10. That's just a general number. I don't know what anyone's comp level is. You guys know what that is. I'm not in contracting, but that's what I can tell people. You're going to get a percentage of whatever they put a lump sum in. You're going to get the bulk of it from the base policy. You're also going to get a percentage of the term writer. There's a lot of different moving parts, but it's somewhere between, I've seen 50 to 55% really is the middle point, because you are taking a little bit of a hit to do right by the client, to give them majority of their cash up front. That's what we're helping people get more access to their cash. You will make more money over time, but that's just kind of what I have to get people to understand, because some people want to do just comp and some don't. You can use it for debts and you can use it for people that have cash, right?
Sure.
$100,000, reposition it, get access to 75,000. We can do that. They have $500,000 sitting somewhere in cash. They wanted to go invest it and they want access to their money and let it compound and grow. We can take $500,000, put it into a life insurance policy, send it over as collateral assignment to another third-party bank, which we have affiliations with, and go ahead and get $350,000, $400,000 of a line of credit tax-free to go do whatever you want to leverage your cash. A lot of different ways to do it. So
absolutely.
Anyway,
so
sorry, man.
No, it's okay. We really appreciate your time, and this was awesome training for all of you guys watching. This is just another tool that you guys can put into your tool belts. I mean, don't think like, hey, this is the greatest thing since sliced bread. I'm gonna start writing everyone with this, because as Scott and I, we've established, this is not for everybody.
No.
So just put your clients first. You know, this is something that you're going to add to it. Continue to put in the work and continue to learn and do whatever is best for that client. So, Scott, we appreciate your time. You know, it's great talking to you. Appreciate the great training.
I appreciate you guys. Thank you, Albert, for all your time. Guys, need anything, just give me a call. Let me know. And it was a pleasure. Thank you very much, Albert.
Thank you. Appreciate you, Scott. Thanks, guys, for getting on.